What we have here, as a result of the tight labor markets, so strong growth, tight labor markets, elevated wage growth, is that we have what I'd call an income-led expansion. That's pretty different from most of the expansions that we've seen during our professional careers, during most of our lifetimes, who are probably on this call right now. Most of the time, we've seen credit driven expansions. So, whether it was in the 2008 period or the tech boom period, in both of those periods, economic activity expanded as a result of either households or businesses taking on substantial debt and using that to finance their spending or their investment in the economy. And when that flow of credit slowed, in part as a function of tightening monetary policy, that then created a really significant slowdown in economic activity as booming credit went to slowing credit. The story today is totally different. Credit growth in the US economy across the non financial sectors is running basically at recessionary levels, at roughly a couple percent of GDP on an annualized basis. And what that suggests is, despite the fact that we're having relatively low credit growth, we're having pretty strong spending growth, particularly from the household sector. And so, how can that be? Well, the way that that works is that we're having an income led expansion. And so, here on the left hand side, what you see is the total compensation of employees received. This is from the personal income and spending report. And what it shows is that uh, the overall household wage and salary income growth is running about 5 or 6%. And then it's notable, which is elevated relative to what it's been in the last, 25 years, give or take. And then you go over to the right hand side and you look at the spending side of things and you see, well, spending is running at 5 to 6%. And so what you basically have is a very sustainable dynamic, because if households are basically taking in a certain amount of wage growth and growing their spending in line with that wage growth, that's something that can continue for an extended period of time because it doesn't have the sort of buildup of debt dynamics that would typically occur in a credit led expansion. You don't have that unsustainable debt boom that eventually starts to slow significantly as monetary policy tightens. And there's been a lot of conversations about other dynamics that are predominantly driving the story. I think folks who have sort of been brought up really focused on the idea of a credit driven cycle are confused about why the overall GDP growth remains so strong in an environment where there's relatively tight monetary policy and relatively low credit growth. And so those folks are searching for solutions, searching for ways to describe or possible ideas in terms of how to describe what's going on in terms of what's financing the spending. One of the most popular theories that has emerged over the course of the last couple of months has been that elevated interest rates are leading to elevated income for the holders of those assets, which is then leading to elevated spending growth. And that theory doesn't hold up when you actually do the numbers. So on the left hand side, upper left hand side, what you see here is the total household interest income earned through time relative to overall nominal GDP growth in the US economy. Those two charts are put on different levels because they're different, meaningfully different levels, but the scale sizes are the same. So you can compare the magnitude of the changes between the two series. And what you see is the overall household interest income that is being earned has risen, but it is a tiny, tiny rise in comparison to overall nominal GDP. And if anything, this probably overstates the story, since the vast majority of households that are earning interest income are higher income cohorts with lower propensity to spend that incremental earned income. On the right hand side, you see the same story basically from a corporation perspective, where elevated rates, particularly for large cash holding large businesses with substantial cash holdings, have have more than offset the increase in overall financing costs because they've locked in long-term debt at low interest rates. But again, the overall picture, the amount of interest income that has occurred as a function of that activity is de minimis relative to the overall moves in GDP growth. Finally, you look at the bottom. Another way to triangulate it is looking at how the government says how much are they paying to households and corporations as a function of their activities, as a function of their ongoing interest payments. And again, what you see there is a relatively modest amount of overall income that is being paid to households and corporations relative to the magnitude of the expansion of the economy. All last month we did a deep dive talking more about the fact that the fiscal story, the fiscal expansion story, is not likely to be, is not the primary driver of what's going on with this expansion. Here, this income from elevated interest rates has been a real focus. If anything, it's an even worse story when you look at the numbers in terms of how big a deal it is. And all of this is really to say there are many folks who are out there in the market who are confused, deeply confused about what's driving this expansion. And that's because this expansion is very different than any that we've experienced in our professional lives. But what I'd emphasize is that this expansion, this income driven expansion, is actually very common. If you look across countries across time, particularly if you start to think about um, economies that generally have less debt as a driver of their activity, uh, often shifts in income growth are the primary driver of shifts in economic conditions. And while the US obviously doesn't have a limit in terms of the credit growth that's occurring, credit growth is relatively modest compared to past cycles. And so the story here is much more like an old time expansion where someone's income uh, leads to their spending, and that spending leads to someone else's income, and that someone else's income leads to their spending, and so on and so forth. And that will continue to occur sustainably until the point in which, predominantly, that there is something that interrupts the desire to spend versus save. And in general, the thing that does that is shifts in asset prices create shifts in desire to save more. To, for instance, a decline in asset prices would create a desire to save more, which would then create a slowdown in spending. And that cycle, that sustainable cycle that exists today, would start to fade as a result.